trying to get to. Would you? And that's for me.
Location fits into it. So the long and the short of it is.
For tuning into the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Good afternoon, good evening, good morning, wherever you are recording from, or sorry, I should say zooming in from. I'm recording from Gold Coast, and I'm just getting confused with the time zones because it changed this week, and all of a sudden everything's I just can't cope. I'm usually in the singular time zone, and everything seems fine. But if you are joining us live, welcome. Good day. You can say good day. We're going to be joined by Pete Wargent, the mighty Pete Wargent, in a few minutes. Hey, Connor, good to see you. And I was just checking our Rask Invest live fake news portfolio and noticed that, like, stand aside Warren Buffett, we're doing this. Only a couple months in, obviously, this is very short-term track record, which does not count in my book. We can see some positive moves from different things. We added XRF Scientific, the small microcap, I guess, industrials business to the portfolio last week. That's risen 3% in a week. If you annualize that, it'd be pretty good. Wise Tech, Wesfarmers, the bond ETF IAF, which we might talk around today, the cash ETF looking pretty, and we've got our outlier is definitely Home Depot. We've benefited from some currency gains there, but also from just some capital gains from America's version of Bunnings Warehouse. So the fake news portfolio available at raskmedia.com.au/live, powered by Pexa each and every day. That's a bit of fun. So, Mr. Leftovers, you said you will be doing a case study on Pexa soon. I'm planning to buy Pexa. Just wanted Pete's thoughts on how the shift towards more remote work impacted the property settlement industry. That's really interesting. Great question, Mr. Leftovers. We'll put that to Pete today. Rob, good to see you in the chat, mate. Percy, tired Steve. I hope you're not that tired. Sona, what have we got? Justin, welcome back. Everyone, it's good to have you with us today. So we will be talking about property. We'll be talking about macro. We'll be talking about all the things that are important if you're building a core portfolio, if you've got property, if you're looking to build wealth, your super fund. I'll get to why we do these particular episodes in just a moment. And the first one that Pete and I did was so popular. We received such great feedback across the Australian Property Podcast, the Australian Investors Podcast, that we just knew we had to do it again. Special thanks to our partners on the show, Pocketsmith for everything automated, budgeting, forecasting, all of that sort of stuff. Pexa for tax reporting. We use it for the Rask Invest Live. We use it for our community as well. A lot of the charts that you see on Rask Media are also powered by Pexa. Super guide for everything, fact-checked articles, planning retirement, switching to pension phase, understanding good supers, bad super, like what's a good strategy, how things performed, understanding those types of things. Super guide is your destination. Special thanks to Perla, the automation and investment platform that so much of the Rask community is now migrating to or is using, and of course our own Rask Invest, that powers the live show. So if you haven't already subscribed to YouTube, please do. It's a great way to stay up to date. We also have a podcast version of the live show. This episode in particular will also feature on the Australian Property Podcast and the Australian Finance Podcast. If you're a fan, you'll hear it twice. Otherwise, there's heaps of great stuff in the back catalogue. We're not going to talk too much with Pete about individual ETFs or shares or that sort of stuff. We will talk about Pexa, don't worry about that. But it's important to understand that when I do, because we did say that we would talk about some companies after we said goodbye to Pete today. So we'll talk about those. We'll talk about the portfolio that we're building together. if we start talking about those types of things together, please remember that anything that I say is limited to general financial information, and for Pete, by the way. We don't know your needs, goals, or objectives. So you want to speak to a professional always before you act on the information. And if I mention things like ETFs or super funds, Pete and I will probably talk about those types of vehicles from time to time, or index funds. Just remember that all those things have what's called a product disclosure statement, or PDS, and a target market determination, or TMD. Now, we've actually named the Rask Invest live show after our service, Rask Invest. And for the avoidance of any doubt, we obviously did that for search engine optimization, or as they say, SEO. But if you are confused, you should just know that there's a service that we run called Rask Invest, and that also has a PDS and TMD, which is available on the Rask Invest website. I know that some of you are investors who are already here today, and you will have read those in order to invest with us. But for anyone else, if you're confused, you can view our ETFs, and everything's on display publicly as well. So just keep that in mind. So Rask Invest Live every Thursday, 12 midday for everyone in the southeastern states. I'm in the southeastern part of Queensland, but it's not the same time zone for me. But if you are interested in markets, money, business, property, super, anything like that, you should subscribe to the YouTube channel and you'll get notified. That's the best way, because sometimes we don't send an email, and sometimes we don't even put it in the community that we're going live. You just know that every Thursday we'll be here. So our guest for today is Pete Wargent. I'm very pleased to welcome Pete. Pete's a prolific author. I think he wrote this book with Kate Bakos, an extremely well-credentialed property buyer as well. I think this is Pete's 7th installation in the book publishing category. He's a podcast host. He's also on social media, sporting a very lovely jumper there, I might say, on his Twitter or X profile. He's also a buyer's agent. He has a buyer's agency in Brisbane. He's a property coach. He's also what I would say is like more of a macroeconomics expert as well, takes a top-down view. So we'll be able to answer your questions and talk about all things markets throughout today's show. So just before we get into welcoming Pete, Steve, I hope you're not that tired. Night shift's just ended, mate. Well, time to pep up a bit for the live show, and then we can say goodnight to you, mate. But Pete Wargent, welcome to Rask Invest Live, mate.
G'day, Owen. Yes, I'm the same as you. I'm on Southeast Queensland time today. Confusing Queenslanders since 1972, but you'll see it has not faded our curtains, and the cows are not confused. So, yeah, it's actually been a little while since we did a state of the market, and the last one was excellent. So, really looking forward to it.
Yeah, it was, and there was really well received because, as I'll bring up in just a moment, it really cuts through the noise. But for folks that maybe folks hear you on the Australian Property Podcast or have read some of your books, you also run a buyer's agency. You part own that up in Brizzy. Can you tell us a little bit about that?
Yeah, so I've been a buyer's agent since 2011. I was originally we were Sydney and London. Those are the markets we originally worked on. Since 2014, we've also had Queensland. So these days we're focused on Queensland and New South Wales. So Newcastle, Central Coast, Northern Beaches of Sydney, and Brisbane and Southeast Queensland. So yeah, a lot of the stuff we do is for interstate buyers and also investors, but also home buyers in Brisbane as well.
Yeah, great. So there's some links in the YouTube description for anyone that wants more information on that. Pete's Twitter handle is also Pete Wargent. So you can find that, and I'll pop it in the chat in just a moment. But Pete loves to answer questions, so bring them on. Maybe to begin, I've got this first slide. So we're going to run through stocks, bonds, super. We're going to run, well, not super, but just multi-assets, I should say. The reason that we do this particular installation, and this is the third installment of this show, the first two featured on the podcast only, but it's a very visual thing that we do with this particular show. And the reason that we do it is you get bombarded with information each and every day in finance. It's a very noisy industry. There aren't many industries where there are websites, some of the most popular websites in the world, that are devoted to one discipline. But you could go to, say, for example, the Australian Financial Review, and it's 24/7, one of the most popular websites in the country. Google Finance is one of the most popular categories of all Googling that happens in the world. And that's because the industry is constantly on this treadmill of information and people want to know what's happening with their money up to the second. And so what happens is it becomes very noisy. And yet we have this kind of mismatch in that for long-term wealth creation, one of the key secrets is slowing down and making fewer good decisions rather than lots of, hasty decisions. And so we try and bring this episode to you to give you an overview of the major buckets of the financial world every quarter. So if you're looking to understand, well, why did interest rates do this? Or what did that inflation reading actually mean? This is the show for you. And this chart here is one that I've took inspiration from Morgan Housel. He did a post, it would have been 10 years ago now, I reckon. And he did this thing where he showed on the X and Y axis, because we're finance and we love charts, how the information that we get impacts us and what actually matters. And you can see down the bottom left-hand corner, you get a lot of emotional clickbait, a lot of uninformed analysis, things like when people come out and write columns and they say property prices are annualizing and they're falling down 26%. And that's the headline. And so everyone just reads 26% down. That's a very emotional clickbait type piece of marketing, not so much important information that you should act on. And then right up the other end of the spectrum, we have information that's quite rare and important. And that would be information that's like news or analysis that requires you to take immediate action. The thing is, saying that property prices go up, 5 to 7% a year is nowhere near as sexy, and it's not going to sell newspapers like annualizing down 26% because of the latest daily or weekly or monthly reading. So we're trying to bring that to you. We're trying to bring some common sense to this so you can build actual wealth for the long term. So Pete, now I'm going to do less of the talking and I'm going to ask you, this is the latest data from CoreLogic. It shows 12-month prices across the country. I'll try and zoom in a bit in just a sec. I guess, first of all, is this something that you're reviewing regularly? What does this chart tell you?
So I do the weekly podcast with Chris Bates. So we're always looking at what's happening. So I guess you're right. Look, if you said over the past year, property prices at the capital city level are up about 7%, but within that, you've got Perth that's up 24%, and Melbourne that's down 1.5 or thereabouts. So it's a bit bifurcated, but that's often the case in Australian property because we tend to have the big capital cities, services-based industries. They're working to one cycle. Then you've got the mining states and territories, which tend to run to a different cycle. So at the moment, pretty strong in Brisbane, Adelaide, very strong in Perth. That's in the boom phase of the cycle. Sydney's a bit betwixt and between. And things are a bit slower, I guess, in Hobart, Melbourne, Canberra and Darwin. But generally speaking, if you think about all the possible outcomes that we might have seen since 2020, early stage of 2020, there's a lot of confusion, lockdowns we'd never seen before, immigration was halted, and then we got all the stimulus from monetary policy and then from fiscal assistance as well. And if you think about all the things that might have occurred through the pandemic, well, from an economic and from a housing market standpoint, we must be in the top decile of potential outcomes there. We've dodged a lot of bullets. So, there's an affordability challenge now in a lot of markets. So that's holding back price growth. But generally speaking, the fundamentals for property are pretty strong at the moment. Population growth's running at about 650,000. Dwelling starts, the figures were out yesterday. Well, the less said, the better, really. About 40,000 over the quarter. So about a third lower than where they need to be.
When you say, sorry, Pete, when you say there's 40,000 and you say it's a third of what
over the quarter, so over the June quarter. So housing starts were quite solid in Melbourne and they're starting to pick up in Perth. But if you look around the country, particularly in places like Sydney, a lot of unit projects are being approved, but they're just not being commenced. So construction sector insolvencies are at record highs. There's probably more lucrative alternatives to build in infrastructure or mining projects. And nobody's really that keen on getting into residential projects. So we've got housing supply running way below where it needs to be. CBRE are forecasting rental shortages out for the next 5 years, which is pretty unprecedented. Reserve Bank of New Zealand cut 50 basis points yesterday. We don't necessarily move in lockstep, but it probably points to what's coming over the next 18 months for Australia as well. And we do, at this time of year, we generally see more listings. It's the spring selling season. And we've definitely seen a pickup. It's probably the best spring selling season in about 9 years or so. But the thing is that just because of the sheer weight of demand, although new listings are picking up and that's dampening the markets a little bit, if you look at the total amount or total number of properties for sale around the country, I mean, if you looked at a graph that went back over 14 years, it would pretty much run from the top left to the bottom right, especially now for the capital city. So yes, we're getting more people selling, but it's actually being fully absorbed by new buyers. And yeah, that's why when you go out to look for properties to buy, especially if you're looking in, let's say, Brisbane, Adelaide or Perth, you'll find that the market's very, very tight. Yeah, I mean, if you put all of that together, plus housing lending is picking up now, especially for investors. The fundamentals overall are actually surprisingly strong, and it's just a general mismatch between very sluggish supply and high rates of population growth.
Do you look at something like this, Pete? Like, say, the chart like this that shows, Adelaide doing really well, Perth doing really well, and you look at like the price movements over time. Do you look at something like this and use that as part of your wealth creation strategy for property? This is a 12-month. They also do 3 months. Sometimes it's monthly. Do you look at this and infer something about how you should manage your wealth?
Yeah, completely. Now, you already mentioned back at the start, with property, it's a much slower moving asset class. You're making far fewer decisions, but the ones you do make are quite big. I think the way you want to look at property is try to have a 10 to 20 year outlook when you buy. I think from a cyclical perspective, it would be better to be buying in a market like Melbourne, for example, where sentiment is currently quite depressed. I think the time to buy in Perth is probably past, I guess, even though you'll get a good outcome over the next 12 or 24 months. It's much harder to snag a bargain. And then when you come to actually sell, I mean, obviously you're probably paying 20% CGT or thereabouts. So there's transaction costs involved in buying and selling. So it doesn't mean you never want to sell, but generally you want to try and hold assets for long periods of time to benefit from the compounding. But if you are going to be a seller, you want to be an opportunistic seller into a very buoyant market. So, for example, if you were selling in Brisbane at the moment, in some of the unit markets, it's a very different setup from maybe 5 years ago when things were quite depressed. So, yeah, I think you want to try and sort of zoom out, as you said, and try and just think more rationally and think slowly. What you don't want to do in real estate is be a forced seller into a weak market or give up on the market cycle just before a boom or something like that. So, yeah, you do want to use those market cycles to your advantage. You want to be buying in the troughs and selling at the highs. And in some ways, it's actually a bit easier in property than it is in the stock market because it's a bit slower moving. So you've got plenty of time to see those big macro cycles playing out.
There was, to change tact a little bit, there was a question from Mr. Leftovers earlier. And the question is not necessarily, so they were talking about a share to invest in, which we're going to review in the next couple of weeks, probably the next month, Mr. Leftovers. So just as an FYI, we'll talk about the company in more detail sometime in the next month because it's a great company to talk about. But for folks that aren't familiar, when you go and buy or sell a house in Australia, 9 times out of 10, you don't actually rock up to the real estate office and grab the keys from the seller. It's all handled in a digital manner now. And the way that settlement, I call that settlement, the way that it happens is now through the Pexa platform, which was originally from banks and the government putting together a digital solution to Australia's big problem, which is transferring money and transferring property ownership at the same time. So, Pete, the question was, do you think that, I guess, the way the property industry has gone in the last few years with remote work, with just generally speaking, has that, do you think, impacted this trend that we're seeing, like with Pexa dominating, or because like you're buying and selling a lot of properties through your buyer's agency and you're coaching a lot of people. Do you see this as like a positive, negative? Like, do you think it's a good platform?
I think, with the financial advice disclaimer, I would be pretty bullish on it for one reason. I think if you were to Google, I can't do a screen share right now, but if you look up housing turnover rate, Reserve Bank of Australia, they will track this over time. And if you went back to, let's say, around the time of the Sydney Olympics, the housing turnover rate, that is the annualized share of the housing stock that actually sells, was about 8%. It was very high. And what you generally find with housing turnover, it's quite cyclical because obviously we get construction booms and then construction busts. Over recent years, the housing turnover rate has fallen really dramatically for a range of reasons. I think a lot of people now, because of the transactions cost in property, like stamp duty, you might be paying 50 or 100,000 when you buy. Then you've got the transaction cost when you sell. People have been holding on to properties for longer to the extent that the housing turnover rate fell to about 4%. Now, there's also a cyclical element to this, though. I think some of it's structural because people are staying put for longer. I think the median period now for holding a property is about 10 years, which is much longer than it used to be. But there is also a cyclical element. At the moment, we've got a real shortage of housing. But if you went back to 2015, 2016, there was units going up all over the place, and therefore lots more transactions happening, a lot more movement even within the housing stock as people were buying and selling more. So I think the housing turnover rate has been very depressed, but it's going to come back once we start the next construction cycle. Now, it might take lower interest rates, lower construction costs, and rising prices to get developers building again, but it is going to happen eventually. It always does. So I would say, without specifically advising on Pexa stock, I would say for turnover, I think the next decade is going to be quite bullish. It's quite different. If you think about the big listing portals like REA and Domain, they don't actually make their money on settlements. They make their money on listings and properties listed, happy days. But for companies or groups like Pexa, it's much more about the settlements. And I think the outlook is actually really strong over the next decade.
Yeah, and a big thing that Mr. Leftovers should know is that Pexa is the big play of Pexa is actually a push into the UK market. And there have been some pretty positive developments in probably the last 6 to 9 months. So if the UK is anything like Australia in the way its digital trajectory, and if there's a few ifs and buts and ands in here, and if Pexa can play a part in that, then that's the real ticket to the lottery, I think, for this business. And
yeah, it's a big market, the UK. Its population 70 odd million, but it will take a bit of time to get established, not least because it takes much longer to transact on a property in the UK with their system, where you've got chains of properties, and this property has to sell, and this one needs to. It can take the process might take a year from start to finish. Whereas down at the Gold Coast where you are today, you could buy a property tomorrow. You could have maybe 10 days to do your due diligence, and you might be settling on that property 4 or 5 weeks from now, potentially. So it's a much quicker market in Australia generally. UK, the time between listing and sale and settlement is much slower. But eventually, once you get an established business, it's a big market over there. So if they can make some inroads, obviously that would be lucrative.
Yeah, you can probably buy anything on the Gold Coast, Pete, even properties that probably don't exist if you're not careful. So just need to be a little bit careful, maybe when you get into certain parts of the country. But the other things which we're going to talk about are shares, shares, inflation, and macroeconomic data. And this is really important because these are like, I think of them as like the tectonic plates or like the ocean currents that move under financial markets. And these are the things that get talked about a lot in the media. I would say without much specificity or without much kind of like granularity that you can actually make a good decision. So, Pete, obviously, maybe we'll try and take these however they work together, but also separately, because these two move in lockstep in a way. We've got inflation in Australia, which is the rising cost of things, which the RBA tries to slow down. It has a target range for inflation of 2 to 3%. In the US, you've got the Federal Reserve, which tries to keep its inflation under control. And recent data is very positive for the US central bank in terms of taming inflation. Here in Australia, there is expectations around interest rates coming down, Pete. But maybe if we just try and I've got charts here on interest rates and so on, as you know, too. So however you want to take this, like I can just move the mouse around to help people understand this. But how are you thinking about the Australian economic picture with respect to inflation and interest rates from here?
Yeah, so let's start with Australia. So we're running a bit behind a lot of the rest of the developed world. We, lest anyone needs reminding, stayed locked down for longer. We had the borders closed for longer. So we're running maybe 6 to 9 months behind some of the other parts of the world. If you look at, say, Canada, US, for example, inflation peaked a lot later here. And the latest inflation figures in Australia, inflation was still 3.8% over the year to June. But from the September quarter, we've got things like energy bill relief kicking in, rental price inflation is cooling, construction cost inflation is at 20-year lows. And I think as well, the government is kicking in a lot of subsidies, which is artificially going to hack the inflation figure lower. So we'll probably find, well, if you look at the Melbourne Institute, they run a separate privately run gauge for inflation. And normally what happens is the Melbourne Institute's gauge runs ahead of the ABS figures and we follow in lockstep. Well, Melbourne Institute has inflation at 2.6%. And if you look at the underlying or the core inflation figures, the last 3 months, inflation pressures have just evaporated. So it may well be that the ABS follows suit when those September figures are released later on this month. And if those figures are softer, well, then we can say with some level of confidence that inflation is defeated in Australia and the next move in interest rates will be down, either in November or more likely on market pricing, maybe in February. I think it partly depends as well on the trajectory for the labour market. Australia's been hiring an awful lot of jobs, but a lot of it's been public sector, healthcare, NDIS, so not really much happening in the private sector, but things have been holding together pretty well. So I would expect if you looked at, if you look at market pricing for the cash rate target out over the next 18 months, markets are pricing in for about 100 basis points of easing, maybe a little bit less. So in plain English, about 4 interest rate cuts maybe over the next 18 months, but probably just nothing just yet because we're just running a bit further behind a lot of other parts of the world because, we didn't really get started on that inflation battle until a bit later on.
Yeah, so rates are expected to fall, and we can use the RBA rate tracker to get a sense of that. Now, these are expectations. We should remind everyone that expectations are not always reality. This chart was also pointing down about a year ago and then started to point up, and now it's pointing back down again. But this is really important because a lot of people don't fully understand how interest rates move through the system. People just think it's just my mortgage. I pay more or less depending on whatever the fella or the Sheila from the RBA says. But we also have things like bond prices. That's the direct beneficiary of falling interest rates, expectations, I should say. So for example, what might happen is if you own a bond ETF and you see the expectations falling, your bonds may go up in value because the bonds that were previously issued are paying a higher coupon rate or payment. And so this has implications beyond just what's the mortgage, what's the borrowing rate for my property, but also to my broader portfolio. It boosts shares, for example, as well. There was a question that came through just now live from Tired Steve, Pete. And they say, Pete, how does the price growth compare between residential housing and over 50s lifestyle resorts? Bit of a question more so around, the different types of property classes. Is resi, maybe if I could even zoom out a bit, is resi the property or the asset class within property that has performed best?
Yeah, it is. I mean, there's all different. As you said, it's a massive asset class, and you do see what's increasingly common, like in the US, for example, things like land lease estates. We're seeing some of those in Australia now, where you effectively are buying an asset, but you don't actually own the underlying land on the property. I would say, generally speaking, those lifestyle estates, you're not going to see the same level of capital growth or land price appreciation. Generally speaking, it's more of a niche asset class. So it's more of a lifestyle decision, I would say. Usually, the best performing residential parts of the market are really suburban properties with a high land to asset ratio. So where at least 50% of the asset value is in the land, and that's the scarce commodity in Aussie property. I think, look, I think some of those other parts of the asset class are a bit more niche and it's a bit more asset dependent. But generally speaking, you probably wouldn't see the same level of capital growth on that type of property. Plus, there's other things to factor in as well in terms of holding costs. Who do you resell to? A bit more of a thin or a liquid asset class. So, yeah, look, it's a bit general, but without sort of making specific enemies, I'd be very careful about things like land lease estates and things like that, because you often find the terms and conditions are somewhat suboptimal to the buyer. So you may find that it's not a brilliant financial decision, even if it looks cheaper on the face of it.
Yeah, absolutely. I think that's a really good point. Is simple is beautiful when it comes to long-term investing in multiple ways. And sometimes there are different ways to cut things up, but it's not always a fantastic investment. I'd say for something like that, Tired Steve, if you're thinking about over 50s, is just get some advice around that. Get some advice around someone that has experience in that realm as well. Percy did make a comment about, based on current supermarket prices, it seems we have had another round of inflation. Based on Perth anyway, fuel prices have been the lowest it's been in many, many months. So they can't use fuel costs as an excuse. Would love to discuss this in the context of inflation if we have time. There's a few things.
Well, that really encapsulates the whole thing about inflation. If you speak to economists, particularly university economists in the US, they're like, yes, inflation is defeated. Inflation is back to 3% or 3.5%. And the soft landing is achieved, happy days. And then you've got the average guy going down to the supermarket and saying, well, what the hell? This is costing me 50% more than I would have paid 3 or 4 years ago. That is the whole debate encapsulated, really. So economists are focusing, particularly the more partisan economists, who are desperate for rate cuts to sort of benefit the incumbent governments in the US and Australia. And you'll see that so in Australia, it'll be the left-wing media, The Guardian, saying it's time for interest rates to fall. Obviously, that would benefit the government. In the US, the same would apply to the Democratic Party. But the thing is, the actual, and in the modern parlance, the lived experience of the consumer is that things are bloody expensive. I've just come back from a couple of weeks in the US. Now, there is an element of this which is currency related. The Aussie dollar doesn't go as far as it used to, but just anywhere you go in the US, the change in the cost of living is eye-popping, and yes, I mean, we've been to some tourism hotspots where Universal Studios, it's a couple of grand for a family now, but that's not a sort of great example. It's more, as the question said there, it's just the everyday cost of groceries, going for a coffee, buying an appliance, getting a phone credit. Everything is just very, very expensive. And yes, there's some things have gone up more than others, but it's about 50%. That's what it feels like. Whatever the inflation gauge says, everything is a lot more expensive. So,
but you can have, Pete, you can have inflation within the basket, right? Like I always come back to my mainland cheese being too expensive nowadays. But like dairy inflation was incredible during COVID because of lockdowns, because of imports, because of so many different things. So you can have inflation within the overall inflation, right?
Yeah, and also, well, that's right. So inflation they neatly distill this down to one number, but the reality is, I was at Harvard last week. A degree from Harvard now was at 440,000 US. So there's some things where inflation just goes up. Veblen goods like a university degree from a top uni, healthcare costs never go down. Construction costs have more or less just gone straight up from bottom left to the top right of the graph for 60 plus years now. But there's other things, though, within the inflation basket that should, in theory, get cheaper. So, for example, if you think back to a bit older than you, but the first television I bought, $1,000, and it was rubbish. And these days, you get something that would be twice as big and twice as good and only half the cost. So, yes, there's some parts of the inflation basket that just go up, largely education, healthcare, quite often alcohol and tobacco because of the sin taxes. But there's other things that do get cheaper. The more you drill into the numbers, the more you realize just how sketchy the inflation figures are, because how do you adjust for quality? So the statistical bureaus will include a hedonic adjustment, but it's very arbitrary when you think about it. How do you actually adjust for the quality of electronic goods from, say, 30 years ago when there was no iPhones to today when we've got like 20 iPads and phones around the house, you know? So it's a very simple number, but it does incorporate a lot of diverse outcomes. So bringing it back to Australia, so the cost of living, people are feeling the pinch. A key difference as well for Australia is that most borrowers are on variable rate mortgages. So when interest rates, or short-term fixed rate mortgages. So when the cash rate target is changed by the Reserve Bank of Australia, there's very quick impact on consumption and the economy. And that's why our cash rate target hasn't had to go as high as in the US, for example, where the federal funds rate was over 5%. The thing with changes to interest rates is it's not a one-time event. If you get a mortgage repayment that sees your mortgage rate reset from, say, 2% to 6%, which a lot of people have over the past 6 months, it's not just once you're paying that, it's every single month. And that's why the economy is really in what they call a per capita recession. We're going backwards once you adjust for population growth. And that's why the next move in interest rates will be down. It's the Reserve Bank's just hanging on as long as it can to just try and kill that last bit of inflation on the official headline index.
Yeah, because I'll bring something up here, and this is back to Percy's point. Thanks for discussing this. It's like, is inflation really coming down? As you said, in reality, it seems not. It's frustrating to hear the media or whatever. It's important to understand here, Percy, that prices are not the same as inflation. So inflation measures the change, but the absolute price, as Pete was mentioning before, is if we've seen inflation of, say, 5% a year for 5 years, that's 5% on top of 5% on top of 5%. Like it compounds. And so, 5% might not seem like much, but over 5 years, it becomes extraordinary. And that's why inflation is such a wicked thing. And it actually can lead to inequality, because a lot of the things that we're talking about impact most of Australians. But the people that benefit from higher inflation, there are some people that can benefit from it depending on how they position their portfolios and their wealth. That's why we have such an important job for our, for capitalism and for the society, is to slow down things like inflation as quickly as we can. And that's why it's important to avoid excessive levels of debt, because inflation will eventually come back, and the government, well, not the government, but the central bank will have to increase interest rates to control it, else you get out of control. And that's happened before, and that's why it's so important to tame it. But as inflation comes down, that does not mean that the price of cheese is going to come down, for example.
The RBA used a specific example a year or two ago to try and justify its position to some degree. But they said, well, if the price of fuel goes from $1 a litre to $2 a litre, then we get a big burst of inflation. But if the fuel price stays at $2 a litre for 1 year, then the inflation rate is zero, even though you're paying double. So it's a bit of a I think it's sometimes the policy wonks forget this, that the average person is experiencing much higher prices, even if the inflation gauge shows that things are cooling off. And just to circle back to the point in the US, well, inflation the rate of inflation seems to be back under or back to sort of around about the target level or just a bit above. But then the latest figures, and it was really noticeable when I was in the US, consumption is still pretty much roaring along in the US. So very bifurcated economy there where some people fall through the cracks and the safety net, but there's enormous wealth as well. And the latest unemployment figures in the US, the unemployment rate has fallen over the past 2 months to just 4.1%. So normally you wouldn't be talking about interest rate cuts in that scenario. Even though there's an expectation that interest rates will fall over the next 18 months, there might be some unexpected outcomes, especially if there's tensions in the Middle East, for example, and oil prices go up, or if the economy holds up better than expected.
Yeah, to Percy's point before, fuel prices could actually go up before they come down. So keep that in mind in a big way. So, and this is one thing that we can see here is, thanks to you, I now monitor this quite closely, is you can also get expectations of what might happen in the US. So we saw interest rates were recently cut and pretty strong. But this is normal in a crisis. You tend to see the central bank cut interest rates more than 0.25% because they want it to have an impact. If they just slowly declined interest rates, it wouldn't have the stimulatory effect. But we can see that in expectations, to your point, Pete, is that the expectations for an interest rate cut next month from the US Federal Reserve is not really there. So if anything, it's more a bit of hesitation that we're seeing there. There was one final question maybe on property, Pete, before we move on, from Johan, who says, looking at the RBA interest rate forecast, does Pete think the Melbourne house and apartment prices will improve in the short term? So for those of you that just tuned in, Melbourne, we saw at the top of the show today that Melbourne property prices writ large, so that means all Melbourne property prices, were pretty weak over the past 12 months compared to many other places.
Yeah, so very topical, because I just about 2 hours ago interviewed Eleanor Cray from PropTrack, and I asked her the exact same question, because a lot of people now come to me as a property advisor and they're saying, okay, well, Victoria, specifically the Melbourne housing market, has been quite weak over the past 12 months or so. Is this a better time in the cycle? And Eleanor said, well, basically, yes, with a caveat. So there's a comparative affordability advantage now for Melbourne, particularly over Sydney, but also to some degree over Brisbane as well. So if you think about the way the market cycles work in Australia, a bit different from the US, where there's maybe 50 similarly sized cities where you might go and you might move to Omaha, or you might move to, I don't know, somewhere in Texas, Austin or something. You know, there's so many different options. But in Australia, you're really looking at Sydney, Melbourne, Southeast Queensland, and a few people go to Adelaide and Perth. There's not many choices. But you do see that the market cycles are driven by comparative affordability. So I moved to Queensland in 2014 when Sydney's house price was 2.2 times as expensive as Brisbane. And I thought, well, surely that gap's going to close. And it did close, but there was a spurt up to 2016, but it's really taken through to 2024 for that gap to be properly closed off. And that was Eleanor's point. Yes, Melbourne has now got comparative affordability play. So a family in Sydney that might only be able to afford a 2 or 3 bedroom unit could move to Melbourne and buy a house in suburbia, and that will start to drive some interstate migration to Victoria. The one caveat you mentioned, there's been some investors selling because of land tax in Victoria. And there's more investors generally offloading properties because of holding costs in Victoria. So in answer to the question, it's probably a good time in the cycle, but it may not be a short-term impact. It's hard to pick the exact timing on this. But as Owen said at the start, you're trying to think in 10-year chunks here rather than what's going to happen next month or in 3 months.
Well, yeah, I was chatting to the fellas from Equity Mates, Ren and Bryce, the other day, and I was interrupted rudely by my chickens who are outside the window. And they said to me, so we had to pause the podcast and then come back and finish off the rest of it. And they said to me, I'm just so envious that you can actually have a place with chickens, right? They're from those two fellas are from Sydney. And the idea is that's it in practice, is if they move to Melbourne for the same, like for pound, they could get a house and have chickens on it, right? But in Sydney, they're going to get an apartment or a townhouse, maybe if they're lucky. And so Yet the incomes are still pretty solid in Melbourne. So that's an interesting way to think about it. Now, Pete, we do want to talk a little bit about like interest rates and in fact impacting the Australian dollar. So one of the things that people would have noticed recently, and if we go to the Rask Invest fake news portfolio, you can actually see this. We've only got one US position in this fake news portfolio, but we can already see that there's been some impact from currency. And if we go to, where's my notes here, we can see that currently, or just today, the Australian dollar is 67.22 US cents. The general trend since COVID has been down, but long-term averages might suggest that it's a little bit above where we are. And we've seen a bit of a rally since the beginning of 2024. How do you broadly think about this? Like, and how do you think about currencies at all? Do you think about where the Australian dollar is, like the trajectory of it, where it's going?
Yeah, I totally do, and not always through choice. I think partly because of my background, about half of my investments are in Europe and the other half are in Australia. So it's a bit of a crapshoot, and it is sometimes a bit of a fool's errand trying to predict this stuff. But generally, much as in the same way in the property market, I just try to think opportunistically. So when the British pound was buying $3 Aussie, you remember the Ashes, the Barmy Army singing about $3 to the pound. Well, that's a good time to maybe transfer some funds and maybe think about investing in the cheaper alternative. But then during the mining boom years, when the British pound was only buying $1.40 or something, well, then you may be thinking opportunistically about investing in the opposite direction. Now, for most Aussies, they're probably thinking more about the US dollar. As you said, the trend over the past few years has been one way. But actually, if you look at where the dollar has gone over the past year or so, it's been, I think it was as low as something like 63, and now it's 67.2 or something today. That's US cents. And I think that's generally reflected that US interest rates are going to come down sooner and harder than in Australia. So I think there's a number of drivers for that. A big one has been government spending has been very high in Australia. So yeah, I try to not spend too much time forecasting short-term moves. And in theory, a lot of this stuff is priced in anyway. But usually I just try and think opportunistically. So when the Aussie dollar was above parity, it's an excellent time for the Aussie dollar. You're picking up assets on the cheap. At the moment, it's 67 cents. Well, I don't even know what the long-term average versus the US dollar is, but it's obviously a lot lower than the $1.10 that we were at during the mining boom years. So, it's hard to predict. I think, potentially if we start seeing Australia's interest rates coming down, that might change the trajectory a bit. But at the moment, we've been actually on the way up a bit over the past year or so.
Yeah, I might. Thanks for that. I think that depending on when you take your average from, it can be, low 70s is pretty standard for that. And it's important to know for people that are investing in ETFs and these types of things, is it actually is a decision you have to make. You make it implicitly by going hedged or unhedged when you choose your ETFs. Like if you choose a US shares ETF, you're getting US dollar currency exposure, so you're going to benefit or lose from that. Whereas if you go with the currency hedged version of the same ETF, you lock in the currency at that point in time. But I wanted to show people something. For anyone that's watching, for anyone that's listening, I'll walk you through it. But we saw earlier on, this is the Australian government bond yields, chart from Bloomberg. And it shows you that on a 2-year basis, the bond yield, which is basically the implied return that you would get from holding that particular bond until it matured and you got your money back, is 3.8%. Now, if you go back and you remember from earlier in the discussion, Pete and I talked about what the market expectations for interest rates are. This is effectively telling you the same thing. It's saying, based on what the market expects, this is what a bond should be trading at. And so when you think about like the return that you get from a bond, it is directly impacted by what the interest rate expectations are. And what's that impacted by? Well, that's impacted by inflation. And what's inflation impacted by? It's impacted by how the economy is doing, whether or not you're in or out of a lockdown, whether or not the Australian dollar is going up or down. And so you can see that kind of reflected in this figure right here. You can see that the bond yield, 2-year government bond yield in Australia is 3.8%. For a 10-year government bond yield, which is another kind of yardstick that people put in the ground, is 4.2%. So that's effectively the implied return over 10 years. Now, if we go to the United States and we go to the same 10-year government bond yield, it's 4.06%. And so now you're starting to see that, oh, well, on this basis, Australian bonds look like they might provide a slightly better return. And so you will see money flood to Australia for investors that are inclined to get that type of return. And so then that impacts the Australian dollar. Maybe you see more Aussie dollars being in demand than US dollars. And that's ultimately what can affect the difference, the change in the Australian dollar and the currency over time, as well as shorter term things. Now, just in the interest of time, we do have this final chart I wanted to show folks. Pete, I don't know if you've seen this data or not, but I've got just behind here, I've got the ASX 200, so Australian shares, the total return since the beginning of 2024. Do you want to take a guess at what that figure might be?
I make myself, I'll see how, I'm bound to undershoot whatever I say. Just to wrap up on your previous point on the bond yields there. So the 10-year rate is what we used to call a risk-free rate. So if you can get 4% with absolutely no risk whatsoever, US Treasury, well, that's kind of a benchmark. You need to be doing better than that to justify taking on risk. What Bloomberg didn't show on that graphic was the 3-year bond yield for Australia, which is a key funding benchmark. And it recently fell to 3.5%. So fixed rate mortgages in Australia have fallen to 5.5%. But just since the Middle East tensions, we're back at about 3.8. So probably won't see much more cuts in terms of fixed rates over the next few months. So I'm going to take a guess. What did you say? Was it 12 months for the ASX?
Before you get to that, Pete, I think there's a valid point here. So you're saying that there's the 3-year in here. One thing to keep in mind when you look at your mortgage is this is why your mortgage will go up and down. To Pete's key point is they look at the 3-year, right? Now, if you take, that's a very poorly drawn 3. We'll just imagine it doesn't look like a seagull and it looks like a 3. If you take the 3-year yield that you see online or from your bond ETF and you add 2% to it, so you add this 3.8 would become 5.8, that's probably around a good interest rate on your mortgage. Why? Because the banks, like a CBA, NAB, that type of thing, they'll take the 2% for their business and you pay 5.8. And that's basically the way it works. So again, we can see all these kind of cogs in this economic wheel piecing together and impacting the way you manage your money and the way you live your life. Now, Pete, the question was the ASX 200, so just the broad Australian share market in total return. So we've got dividends plus or minus growth year to date, 2024.
You're going to make me look an idiot here. I'm going to go for, just on that bonds point, we've got a higher inflation target in Australia than the US, so you might see our yields are a bit higher on average. I'm going to go for 20%. Tell me I'm wrong.
Okay. 12%. Over, but that's year to date. So 12% return.
Whoa. Are we talking? Yes, I was going for the 12-month return.
Oh, mate. So, well, then you're spot on. You got it at it's 20.5%. So
yes, okay. Yeah, that's so yes, you're right. Year to date, I would probably have gone, I don't know, 11 or 10 or something.
Yep. Well, spot on, mate. And for the US, we've got year to date 22% or 23%, depending how you round it. But that's when you think about where we were as a public kind of consciousness, investor zeitgeist, if we could use such a phrase, about a year ago, people would have been, well, geez, interest rates have gone up. I don't know what's going to happen with property prices. The share market looks expensive. The US CAPE ratio is really high. Donald Trump is going to do this. Like Israel, Gaza, tragic things indeed, Ukraine, so many things wrong in the world. But the stock market still went up 20%.
So the stock market is forward looking. Out of interest, what's the US return over 12 months? It must be like 35 or something. It's been absolutely wild.
I'll bring it up. I've got it in my link to it in my notes here. It would have to be something like that. It's Let's have a look. So 1 year, 37%, 36%. That's the S&P 500.
It's an expensive mistake to be sitting in cash if you've missed 37%. Yeah, there's always a case for a balanced approach, but ouch.
Yeah, yeah. And for at least 10 years now, Pete, people have been saying, "Oh, the US stock market's expensive, the PE ratio, this and that, this and that." Same with the Australian market. They say it every, we're doing this every 3 months. They've been saying it for a lot longer than that. And I think like Drew Meredith, who I know you know, always says that it's not about predictions. It's just about being prepared. And imagine not having some US shares or not having some Aussie shares or not having some property because you read something or you saw something. That is the big risk that people make and take with their money.
Well, that's I think the thing to think about as well, because I often hear people say, oh, "I really regret I sold a property in London 20 years ago or Sydney or whatever." But you got to think about opportunity cost as well. If you've sold an asset and then just kept your money in a bank account, well, yeah, sure, that is a point to regret. But most often that doesn't happen. People are going to get invested in the stock market or put their money into another asset. So, yeah, as you said, you just want to try to be as well prepared as you can and try and think as rationally as you can. You'll never get everything spot on. That's just not how it works.
No, not at all. Pete, I just realized it's now 1:00 and we were going to do this for about 40 minutes, but I hope no doubt everyone that's listening and watching will have got something from it. For those of you that are watching live, I've put a link in the show in the chat to Pete's new book with Kate Bakos. The buy right approach to property investing, mastering the skills to invest wisely in property. Pete is also available on Twitter/X. Do you call it Twitter or do you call it X, or what? How do you refer?
I call it Twitter, but I suppose I'm a year out of date. It should be X, I guess these days.
Yeah, some people are calling it Twitter just as a one up on Elon, but yeah, people can find you on Twitter at Pete Wargent every Sunday morning on the Australian Property Podcast, as well as throughout the week. People can tune in. You have a buyer's agency based out of Perth, but I'd imagine that you deal with people everywhere because you're also buying properties in Sydney and up the coast. We can put a link in the YouTube description for that. But if you're ever in doubt, just Google Pete Wargent and something is bound to come up, mate.
Good or bad, yeah.
Good or bad controversy. Someone bringing up an economic data point that you mentioned 15 years ago. But no, seriously, you're easily the most trusted for me when it comes to property insights in Australia, easily, which is why I'm just so thrilled that you spend some time every week, every Sunday, to share that with the Australian Property Podcast listeners. And mate, your new book out. You're back in Oz. It's great to have you back. So, mate, awesome. Thanks for joining us today.
Always a pleasure. Thanks, Owen. Yeah, you never get everything spot on, but as long as you update your priors and make your predictions and advice in good faith, you tend to be more right than wrong over time.
Yeah. And also, I think the glass half full approach definitely, when it comes to being balanced as well, helps. So, mate, so many good insights. Thanks once again.
Cheers. Thanks, everyone.
So that was Pete Wargent joining us, also from Southeast Queensland. He's back in the country, which is great to see. But you can catch him on the Australian Property Podcast. I should put a link in the chat to that if you haven't already tuned in. It's 2 episodes a week on the Australian Property Podcast. Every Sunday is the particular episode that goes live with Pete and Chris. So Chris is Australia's #1 mortgage broker, and you just heard from Pete. And Amy is coming back to the show soon after a brief break. So we've got an absolute all-star team there. I occasionally fill in. I'm kind of like the person that comes off the bench, and the coach looks over at his bench or her bench, and he goes, "What have I got on the bench?" And then they look over and they see me, and then they look the other way. They're like, "Oh God, I've got to put him on." So occasionally I go on the Australian Property Podcast, but it's really just to play moderator for the others who bring the insights. So a quick update. We probably didn't have enough time to get through some positions today, but I'm going to add Pexa to the list for us to review accidentally clicked that button, for us to review as part of Rask Invest Live. You can view the Rask Invest fake news portfolio here at raskmedia/ live. You can also contribute in the community. I know most of you who are attending today live are in the community. So you can jump in here. You can put in this events section here. You can see what's happening in the week ahead, and you can just pop a comment in here of companies that we should cover. If you haven't already tuned into last week's show, some of the companies that we talked about there were XRF Scientific. We talked about getting stuck into some gold ETFs and these types of things. So they're still on my list. I still want to get to them. We've got plenty more to get through. So the next couple of weeks, actually it's next month, we're also doing a bit of a retirement, not a series, but we've got some retirement style shows. So like passive income, how to prepare your super and your non-super investments to draw income from your portfolio. We've also got, remember that the first Thursday of every month is when we dive deep into stocks and ETFs and funds. So that's specific. We've also, for the Q&A next month, we've got a financial advisor coming on the show to help me answer some of your questions, because we got so deep into debt recycling 2 weeks ago that I was like, I just need someone to bounce some debt recycling 101s off. So we've got a financial advisor joining us at the end of November to answer more questions. You can ask your questions in the community, or you can send them in with the Ask a Question link. It's in there. Also, I will give you a sneak peek. Now, you might think that, hey, Owen's just in Southeast Queensland doing Lord knows what at Movie World, but he's in a t-shirt. What's going on? Well, what you can't see underneath this is, in addition to being in shorts, there is also something that's on my shirt, which is coming in about 20 days. So in about 20 days, we are going to roll out a total facelift to Rask. Where is it? Here it is. A total facelift to Rask. And I am super excited, because what we're doing is we're bringing changes to everything at Rask, not just the way you see it and the way it looks, but basically transforming our network and our podcast and our business. So this will be the biggest change we've made in probably 3, maybe 4 or 5 years. And you're going to see a lot more from us in terms of what we are doing to help educate people, to help invest for people, to help people get financial advice, and so on. So you all here today are the only ones that have seen this. And so, other than maybe someone who's seen me walking down the street, but I am really excited about this, and you'll hear more about it over the next 3 weeks. You'll see more of it in the next few years, no doubt, but in particular over the next 3 weeks. So it's been a work in progress for a very long time, and I'm excited for that. So yeah, watch this space. We'll be back next Thursday. I'll be joining you back from our Melbourne office next Thursday. And if you do want to keep up to date, don't forget to head over to any of the Rask websites and just put your email address in, create a free account, take a course, whatever, and you go on the mailing list. Every Sunday, I send you an email, and it has the top podcasts, the top free reports, the top, stock reports, property stuff, whatever. We do so much with our amazing team that the Sunday morning email is the one that kind of combines it all and just pushes all the best stuff to the surface, and it's free or whatever. So you can get that. And other than that, I will see you next Thursday, and we'll be talking hopefully a couple more companies next week and a couple of ETFs. So thanks, Percy, PDB, Pneumatic Duke. Love the name. Johan, thank you for the questions. Rob, good to see you. Sona, everyone, lovely to see you. Thank you. Big thank you to Pete. It's just awesome. So it's so good to have him on the show. And we'll be back same time. That's 12 Southeastern time next Thursday. So thanks once again for joining me. Thanks for taking time out of your day. Bye for now.